Hello everyone, it is Friday, March 28, and today we'll take a closer look at the euro and the British pound charts to assess potential market shifts. As we can see, the European currency recovered in the first half of the previous trading day, extending its rebound from the sharp, tariff-driven losses seen earlier. The upward move was supported by stronger-than-expected euro area data, particularly in household lending and M3 money supply growth. Later in the day, market attention turned to U.S. economic indicators. Gross domestic product was revised up to an annualized growth rate of 2.4%, while the personal consumption expenditures price index posted a solid 2.4% gain over the final 3 months of 2024. Initial jobless claims also came in stronger than anticipated, tempering the rally in both the euro and the pound sterling. Despite the firmer US data, demand for the risky assets persisted, leaving the dollar on shaky ground and capping its gains against European currencies. Turning to today's macroeconomic calendar, the spotlight in the first half of the day is on UK GDP figures. The British economy is expected to have grown by just 0.1% month-on-month in the fourth quarter of 2024 and 1.4% year-on-year, disappointingly weak numbers. And the actual data falls short of these modest expectations. The pound could come under renewed pressure, likely putting a cap on the pound-dollar pair's recent bullish momentum. Also on the UK docket is data on retail sales, which is projected to show a decline. While this would be a negative signal for the economy, it could help ease inflationary pressures, an outcome the Bank of England would welcome at its eyes, further interest rate cuts. Still, any sharp drop in consumer spending would likely deal a blow to the pound. And the euro area Friday's calendar is relatively light, with the main focus on Germany's unemployment rate. The unemployment rate is forecast to remain steady at 6.2%, though the number of unemployment is expected to rise by 10,000 in March. If the data meets expectations, the positive impact on the euro may be limited. However, signs of resilience in the German labor market could offer modest support to the single currency in the early trading. Speaking of US statistics, all eyes will be on the core PCE price index, the Federal Reserve's preferring inflation gauge. It is estimated to have risen by 2.7% year-on-year in February, up slightly from 2.6% in January. Any indication of cooling price pressures could reinforce the Fed's case for continued rate cuts, weighing on the dollar while boosting risk assets. Also due Friday are reports on US personal income and spending, both of which are key indicators of consumer strength. In addition, Fed officials Michelle Barr and Raphael Bostic are scheduled to speak today. Given that the dollar has reacted positively to statements by American policymakers earlier this week, their remarks could once again influence market sentiment. Let's now move on to technical analysis. The 1-hour EUR/USD chart suggests that a false breakout at 1.0801 would trigger a sell signal, dragging the euro down to 1.0764. Buyers are expected to step back in around this level, which would make going long on a false breakout a valid strategy, targeting an intraday correction of 20-25 pips. Going long would also be relevant at 1.0736 on a false breakout or at 0.691 on the rebound, with upside potential of 30-35 pips. If selling pressure appears weak at 0.801, short positions should be deferred to either 0.830 on a false breakout or 0.860 on a rebound in anticipation of an intraday correction of 25-30 pips. Meanwhile, the British pound appears to have completed its bearish correction, with the price returning to a broad sideways range. Sterling may gain bullish momentum, but these would require upbeat data on UK GDP growth. A false breakout at 1.2940 could offer an opportunity to open long positions, potentially lifting the pound towards 1.2964. If the price breaks through and consolidates above this level, the pound sterling could rise to 29.88, potentially reaching 30.10 mark. At this mark, I would recommend going short on the rebound targeting a 20-25 pip move. Short positions at 29.64 and 29.88 should be considered on a false breakout. On the downside, weaker than expected UK data may trigger a break below 29.40, extending losses towards 29.22 and potentially 1.2901. At this level, it would be wise to open long positions on rebound in anticipation of an intraday correction of 15-20 pips. Going long at 29.22 and 29.40 would only be prudent in the event of a false breakout. Good luck and have a great weekend.